Satyam Panday is Chief US and Canada Economist at S&P Global Ratings. He's with us. Satyam, good to have you with us here. Thank you for your time. I think we can stop talking about, not stop, but talk less about geopolitics and maybe start talking about trade and its impact on the economy. What are you modeling in, Satyam, as that we get to that deadline, almost just over a week away? Universal tariffs, I don't know if letters will be sent or how it'll be done. Or do you think, since this was a self-imposed deadline, that 9th of July deadline, if the Trump administration feels that maybe we are getting close, but we need more time, they just extend it. I mean, so it's not sacrosanct in that sense.
It could be, yes. It could very well be. You have the July 9th deadline coming in, but there are some trade negotiations that are on way right now. If they're not done, if there's been sort of an honest, faithfully done negotiation that they think is going to lead to some form of a solid deal, they may very well just decide to roll it over with that particular trade partner, right? But in general, it seems like at least by July 9th, you should expect a minimum tariff rate of 10% across the board, sort of a global tariff rate. And then with various trade partners, you would have individualized tariff rates. And specifically, think about the strategic products like semiconductors and pharmaceuticals, some critical minerals. Those are going to have higher ratios, like the steel and aluminum, and the cars, like 25 maybe perhaps. But altogether, we are of the view that perhaps it's going to converge into a 15% effective tariff rate that the U.S. imports are going to be facing altogether. Of course, it's going to be varying for different countries. Like China is probably going to be seeing higher than that, maybe around 40%, while Canada and Mexico lower than the 10%. But overall, 15% sounds reasonable right now at the moment, of course.
So, the question is whether he'll kick the can down the road, as they say, right? Whether July 9 holds or not. But, Satyam, I think, and that's exactly why markets are rallying. Markets are unperturbed because as of now, growth is fine, corporate numbers look okay, inflation numbers don't look too bad. And therefore, the US equity market is where it is. What do you forecast for the second half? Do you see a more serious pickup in inflation? And if that's the case, would it be foolhardy to expect any rate cuts from the Fed?
We do have a pickup in inflation in the second half. We do think there's going to be a slow motion, sort of a slowdown in economic growth as well. So you've got the loss of purchasing power in the consumer class, because a lot of these assumption of tariffs and some of the tariffs already in place, it is going to be passed on to the consumer at the end of the day. Right now, you may not be seeing it just because a lot of the inventory accumulation, the stock that the companies had actually front run before the tariffs, that is going to have to be restocked again. And that is when it's going to be very difficult for them to not pass it on to the consumer. So we do think inflation is moving up in the second half to about 3 to 3.5% on a core CPI basis. That means you will have a slowdown in the economy as well. And it's not just the inflation, we've got high interest rate that has been affecting the domestic demand in the housing sector, on a lot of other interest-sensitive activities, right? So we shouldn't lose sight of the other domestic issues going on. All of those combined together, second half looks like we will see more like a 1.1% GDP growth by the end of the year, compared to what we saw 2.5% last year in the fourth quarter. So that's a material slowdown in growth picture, although not a recession.
All right. Hi, Satyam. Good to see you, Ben. So for the year, then growth estimates would be what? Around 1.6, 1.7% in the United States?
Yeah, on average 1.7, but a weakening profile as we go through the year. And then once you get some of these tax cuts and the incentives that are embedded in what we call the reconciliation budget discussions right now, once they kick in and the Federal Reserve starts to perhaps lower rates, then you will start to see the usual pickup, the cyclical pickup in the economic cycle, which should get you back towards 1.92% by the end of next year.
Okay, all right. So a couple of points then on that front. Do you believe that the U.S. will ultimately move into a recession? Point number one. Point number two is the Fed's, the Fed's role plays a crucial part out here, right? For this year, I think you're factoring around 50 basis points cut. And I think for next year, you're factoring in a bigger one. Could you run us through what are you moving with regard to the Fed action?
In the first point, in terms of the probability of a recession within the next 12 months, let's say, we have currently pegged 30 to 35% probability. Now, that compares to 13 to 15% in a normal time. You always are running some probability of a recession, right? That's somewhere around 13 to 15% in the US. But this time, given all the uncertainties, either it be geopolitics or uncertainty in business investments due to policies, we do have it a little bit elevated to about 30 to 35%. Now, so it's not a recession in our base case, but we do have a weakening profile. That means you are going to see unemployment rate drifting up. And that means the Fed does have to make a decision. It's a tough one because we are saying inflation is also moving up. At the same time, the economy is weakening. So the Fed has to make a decision, and I think they are probably going to lean towards cutting rates by the fourth quarter of this year, 50 basis points. They will look through this inflation uptick as a one-time inflation uptick, and they would rather give an insurance cut looking at the labor market. And then you will start to see another 75 basis points rate cut next year. So most likely getting us back around 3 to 3.25% by the third quarter of next year.
Okay, all right. We'll leave it there. Thank you very much for joining us. Good conversation and good perspective with those numbers as well coming through.